Steps of VC investment process. Another question I get a lot is, how do VCs go about making their investment decisions? If I had the answer and formula for this, I would be a richer man. One thing I can assure you is that you should not anticipate that it will happen in a single meeting at some restaurant or coffee shop. The reality is that there are generally multiple steps of conversation that you'll have to go through, and a lot more time than you think. After you've contacted a VC directly or through your network, many VCs will ask you to send materials beforehand, and they'll often ask you to send what's called a deck, your PowerPoint, so they can review it. I have an interesting perspective in this particular element. It's a little controversial, but just listen to me. I do not send my deck to investors before I have a chance to present it to them. The only time I suggest you share a deck is when you're presenting in person. Now, don't misconstrue this. This suggestion is not indicating that if you send a deck to an investor, they'll use the information to support another company or for competitive purposes. The reason for this suggestion is because investors actually invest in you, not pitch decks. You want them to meet you. You may not come across the way you think in your pitch deck. It's important that you try to get a meeting with your investor. When an investor asks for a pitch deck or something in writing prior to an in-person meeting, try to provide them with a very powerful 1 or 2 page executive summary. This is the summary of your business, ideally in 1 page. We call it a teaser. Its job is to give just enough information to get the investor to say, I want to hear more. Come and see me. I don't want to sell them on my business. Just sell them on the meeting. The purpose is to get that meeting. In all my years, I've never heard of an investment being made on paper material. The investor invests in you. You really want to get a chance to get in front of them and have them meet you in person. So you have to work hard to get that first meeting. Let's pause the sequence of things to prepare for and talk for a minute about who actually makes the investment and how you get there. Your first contact and meeting is likely to be with what they call an associate, a screener, who isn't actually part of the decision-making process for the investment. They're just a screener or recommender. Make sure before you go into a meeting, you know who will be there. If it's a recommender, don't sell them on the investment. Sell them on getting a meeting with the partner who can actually support and make a decision on an investment. The first meeting is all about getting a high-level understanding of who you are, what your business is about, and to figure out if there's a good fit. This is to see if it's interesting for investors. This is where you bring in your initial pitch deck. We'll discuss pitch decks in more detail in the next module, Pitch Perfect. Be prepared for this first meeting with an actual partner. It's the most critical meeting you'll ever have. Ron Conway, one of the top investors in Silicon Valley angel groups, who invested in Google and Facebook and Dropbox and a bunch of others, said in an interview that he makes a decision within 10 minutes of meeting an entrepreneur. He actually thinks he makes it in the first 2 minutes. He looks for passion, confidence, experience, expertise, and integrity. Is this a capable executive that's a problem solver? Those are the ones who win in this game. This does not come from your deck, especially not by putting a business plan into a PowerPoint. It comes from your knowledge and your passion and your ability to build trust right off the cuff. We'll talk in depth about this in the Venture Basecamp Pitch Perfect module. If investors find the first meeting interesting, they'll arrange for subsequent meetings. But if they find that this really isn't interesting for them, you can expect them to say something like, hey, thank you very much for coming in, but unfortunately, you're not a good fit for our firm. Don't be discouraged. Many times this is just to do with their investment thesis. For instance, if a startup comes up to our affiliate fund in India and they don't have any impact focus, then that fund can't invest in them. As an example for Unitas Ventures, If a promising fintech startup comes focused on high-income segments of the Mumbai area, let's say, it presents a great business. It's an investable business, but Unitas can't touch them. They can't. Remember, it's very unlikely that a first investment conversation that you have will be the one that turns into a real investment. Some startup team members we know have talked to over 100 investors before they got to that yes they were looking for. In the second follow-up meeting, the investor may bring in a couple of team members to meet the startup team. The idea behind that is to figure out whether other people at the fund also think that you're a good fit and they want to meet more of your team. At this point, you'll need an investor pitch. The investor pitch should be focused on more details and presented in maybe a 20-minute conversation. In this conversation and pitch, you should cover business unit economics as well as a deep product dive. As I mentioned, we'll discuss the investor pitch deck further in another module. The next general step in this process, assuming that you've talked with at least one partner and there seems to be a potential fit, is what we call due diligence. During this process, the VC will probably be looking at your management, product, market potential, business model, financials, all your paperwork, your legal status, everything under a microscope. Be ready. Remember, investors invest in great leaders. If you're unprepared or tentative about your business and answers to questions, at some level, they'll think you're unprepared or tentative about your business. Investors will be looking at over 100 different questions regarding your startup. Many are asked directly, but many are unsaid, and they're said in their own head or within their own partnership. We'll be delving deeper into some of those questions as we proceed further in this module. If the answers are leaning positive, your investors will take a deep dive looking into backgrounds and financials and business models and the market and competitors and more. Investors are using funds they've raised from limited and general partners to invest in a company. So they're answerable to multiple entities. They'll leave no stone unturned to get answers to every one of their questions. The good news here is they like you well enough to start doing due diligence. That means they're seriously interested in you. But I've got to give you a clear understanding that only about 50% of those deals that actually get to the point of deep due diligence and getting to what's called an IC or investment committee get funded. This could be due to any one of a series of issues. It could be simply the investor didn't really understand your fundamental business, or there was a conflict that came up, or they unearthed things that made them nervous. A good example of this can be found in the business case about HQ Trivia, a very popular online trivia app in the United States, which started by a co-founder from other successful businesses like Vine. A quick Google search on this will show you that there were a series of articles to discuss how VCs took a look at that business, and when they got under it and they got deep into it, unearthed things in that business, they decided it wasn't something they wanted to fund. Here's the next thing. Be ready. One thing that will really help during that due diligence process is to have everything ready, to be very responsive. This will set a good impression, and it'll make things happen smoothly. It's helpful at this stage if you could think like an investor and anticipate the questions they might have regarding your startup. This will help you provide them with all the documents, for instance, that they need or require in a timely manner, thus expediting the process. Well-prepared venture-backed startups have what is termed a data room, an electronic place online where they anticipate and place all the documents and any anticipated responses that are commonly asked by investors all in one place so investors can get at it, look at it, and access it easily. If you have a data room, you'll be a rarity, and it will reflect on your preparedness, which again reflects on your management capability. If you may not have answers to all your questions, that's okay. Investors aren't looking for a startup with all the answers. They're looking for a startup who has a great team, who are able to be good listeners, fast learners, and great problem solvers. A very acceptable answer to a question is, I don't know yet, but I'll find out and I'll get back to you. Or maybe it could be, we don't have an answer to that question, but we've been thinking about it a lot and we're looking very hard to find that answer. To assist you in this process, we've shared a checklist of more than 100 questions that investors might ask, broken down into various elements or segments based on the critical success factors of Venture Basecamp. An analogy of this entire process of receiving investment from first meeting to due diligence would be dating. Imagine that you're in a dating pool and you meet somebody and you go out with them and you think, wow, this is somebody interesting. At this point, you don't say, hey, look, I'd like to marry you. You start off by getting to know them. You say you're interested in them and you check to see if that interest is deep, if it's real, if it's a good fit. You check out the other person's story in life and see how you're compatible. And then you go into a few more dates to see if things are serious, if things really work well. The investment process is very similar. As a general concept, investors are trying to understand if you have a vision in your mind or just a dream. Through these various meetings, they're trying to evaluate if your vision is likely to become a reality. The deep dive of an investor can have value in several ways. Not only will you learn what's important to an investor, you'll see where you might need to improve your business or revenue streams or product or competitive stance. You'll be able to really look deeply at your own team. And it's also important for you and your investor to see how they can be helpful beyond their funds. Where do they have knowledge, experience, and resources and connections? Remember, the investment process is very much of a two-way street. You're looking for a partner who brings funding, not a bank. As an investor, I learn as much about an investment by the questions entrepreneurs ask as the answers to those questions I ask. Don't be shy. Be ready with a set of thoughtful questions to ask your investor. So your investor is continuing to be interested in investing in you. What happens next? After due diligence, the VC firm will organize an internal investment team meeting where the investment team of that group will get together to decide whether to take your startup to the next step of decision making, which is what some people term a partner preview. During a partner preview, the investment team generally meets all the VC's partners and the next step in preparing for what's called an IC, or Investment Committee decision. The team presents and discusses the investment in an open forum, discussing areas of concern and interest. If you get a partner buy-off, the next step is to get ready for the investment committee. In general, the investment committee makes the final decision to present a term sheet for investment to you. The IC is often made up of the managing directors or managing partners of a firm and possibly a representative of maybe some of the limited partners. Again, keep in mind that up to 50% of deals brought to an investment committee are still rejected. That's why we suggest that even if you've got strong interest from an investor and you're working through the process, you should continue to forge ahead with other potential investors. In fact, I'll deny this if you ever say I said it, but it's not a bad idea to use the engagements with other investors as a little bit of a lever to keep things moving along quickly and in your negotiations. Wait, we're not done yet. The investment committee needs to approve the investment, and they do so contingent on a financial agreement, on terms, and on what's called final due diligence. You'll likely receive a term sheet with an outline of the terms that are proposed for the investment. We'll cover term sheets and negotiating a win-win investment later. For now, just know that the term sheet is a summary of the details of the terms under which they'll invest. It includes things like initial purchase price, percentage stake they expect, the valuation. And it'll have other things like restrictions on your funds. No, this is not a time to buy a new personal sports car or helicopter. There'll be covenants, there'll be purchase rights for additional offerings, and other things. Pay close attention here as this is where an investor can often put in subtle language about their ability to replace you if they're not satisfied with your results. After you get through all of that, one more thing to know. The term sheet is non-binding. What that means is that a party involved in the term sheet can break off the negotiations and walk away without any legal repercussions. Although sometimes investors will actually try to tie you up while leaving an out for them. Okay. There are a lot of articles and materials online with regard to term sheets and the process of negotiating. Go take a look at those, and we'll talk more about some of those items in our term sheet module. When you've agreed and signed the term sheet, you'll proceed to what is often termed final closing documents or definitive agreements. They are things like what are called a share purchase agreement or a shareholders agreement and other things. We'll cover that later. You'll need, at this point, to make certain that you have good legal help. When all these things are signed, that's when you'll see your money. The entire investment process is a long one. Typically, it takes anywhere between 3 to 6 months, sometimes longer. At times, it might take 2 or 3 months just for lawyers of both parties to go through and agree on the final documents. Just in case you think, wait a minute, I've heard about deals getting closed in a couple of weeks. Yes, that's true, that happens once in a while, but they're very rare, just like the occurrence of those great deals that you hear about. Remember, when you start looking at fundraising, you need to make sure you have enough financial resources to last the duration of the investment process. There's a saying, never look for funding when you need it, especially when you're desperate. Investors will smell that, and they'll either walk away or they'll take advantage of your need for capital to get a very preferential price on your stock. In summary, be informed, be ready, and prepared. Remember, as an entrepreneur, while you're solely focused on your startup, the investor is working on a portfolio, so there are multiple startups that they're working with. There are many factors that go into an investment decision for a venture funder. Some of those things you have control over, others you don't. Investors will have over 100 questions. We have over 245 on our checklist. They'll need to answer all of them. Some they'll ask you out loud directly, and some they'll ask internally. You have to be prepared to answer all questions. How do I answer questions they haven't asked? We'll get to that. Investors invest in people. They invest in teams. Management first and foremost. You need to be prepared, confident, passionate, and committed. Yes, have all the answers. But more importantly, know your business and think of it like an investor. You can substantially expedite the timeline of investment by actually thinking like an investor throughout the startup process and being prepared with all the answers and the documentation that specifically address what investors' concerns are. Remember, as the biggest investor in your startup, conduct your own internal due diligence. Know and be able to articulate your value as a business. Don't wish, dream, or sell. Know.